We have seen single candle patterns like the hammer and the shooting star. Single candles can give important information about supply and demand simply through the color, the length of the real body, and the length of the shadows. Now we are going to analyze combinations of individual candles. The engulfing pattern is a major reversal signal with two opposite color real bodies. In this lecture, we are focusing on the bullish engulfing pattern, so let's have a look at the properties. As I have already said, it is a two-candle pattern. The market then must be in a downtrend. This is the most important condition, and this time is not the last one because we need it to understand the other conditions. So the first candle must be red, in line with the previous trend that is down. The second candle must be green, with a real body that surrounds, or we can say engulfs, the real body of the first. Last one, the position of the shadows on either candles doesn't matter. What's the logic behind this pattern? We have a first candle that is confirming that sellers are in control of the market. Traders are expecting then another red candle, in line with the downtrend. But here it comes a long green candle that engulfs the previous one, showing that buying pressure has overwhelmed selling pressure. Here we have United States dollar, Japanese yen on an hourly chart, and you can see that the price is going down, so sellers are in control in the first part of the chart. At the end of this downtrend, there's a bullish engulfing pattern. So, analyzing the price action on the market, we can say that sellers were in control and they pushed the price down for a long time without facing any major resistance by the buyers. At one point, we can see a bullish engulfing pattern that is basically telling us that buyers had a strong reaction compared to the previous session. So the bullish engulfing pattern is a clear signal that the demand increased, maybe because the price is too low and buyers find convenient to buy. Now that you know the bullish engulfing pattern, can you imagine how the bearish engulfing pattern is? We'll see it in the next lecture. The bearish engulfing pattern is just the opposite of the bullish engulfing pattern. Let's have a look at the properties. First of all, it is a two-candle pattern. Then the market must be in an uptrend this time. The first candle then must be green, in line with the previous trend that is up, and the second candle must be red. The real body of the second candle must surround the real body of the first candle. And last one is that the position of the shadows on either candles doesn't matter. So if you got the logic of the bullish engulfing pattern, the bearish engulfing pattern will be very easy for you. Let's follow this example on dollar Swiss franc 4-hour chart. The trend is clearly up, but at one point there's a bearish engulfing pattern that is a clear signal that sellers are strong at that price and might have the power to change the trend. Just a quick tip to increase the likelihood that the engulfing pattern will succeed. The engulfing pattern becomes more significant if the first candle has a very small body and the second candle has a very long real body. This is because the first candle reflects a dissipation of the prior trend's force, and the large second real body shows an increase in force behind the new move. Tweezer's top and tweezer's bottom are the candlestick version of support and resistance. Tweezers, in fact, are two or more candles with the same highs or same lows. In an uptrend, a tweezer's top is formed when two or more consecutive highs match. In a downtrend, a tweezer's bottom is formed when two or more consecutive lows match. The logic of this pattern is that if we have two or more consecutive highs or lows, it means that that price is hard to overcome. That's why I introduced this pattern as a candlestick version of support and resistance, because it reminds me the same logic of support and resistance. Here we have euro-dollar on a 4-hour chart, and I have zoomed in to have a better view of the pattern. As you can see, euro-dollar is in an uptrend. Then there are two candles that reach the same high. Could it be that sellers are selling the currency pair at that price and buyers struggle to go over it? In this chart instead, we have pound-dollar on a 4-hour chart. You can see that sellers are in control at the beginning, but they can't break the level that is formed by the two lows of the tweezer's bottom. Last thing, I want to give you a quick tip based on my experience on the forex market. The tweezers work better when they also form another pattern. For example, here we have a tweezer's top that also form a bearish engulfing. This one is a tweezer's bottom with a second candle that is also a long-legged doji. In general, when you have more clues that indicate the same trade to take, it is better. That's why when the tweezers also form another pattern, you have a stronger signal.